Hey, welcome to our webinar. My name is Doug Tarter and I'm with Berkshire Hathaway Real Estate. And buying your first home really isn't confusing, and it really is. There's some great programs that make it incredibly simple and easy. We've got one of the best experts in the industry to help you navigate that financial aspect, which is the most critical part of buying your home. And Gary Munson's here with us, and he's going to walk you through the steps of buying your first home.
Thanks, Doug. I appreciate that a great deal. My name is Gary. I'm wildly excited to go through this stuff because lending is my passion. Putting people in houses is what gets me up out of bed in the morning, and I absolutely love seeing people get into their homes. And so let's talk about the stuff that you need to know as you're moving into this situation. So if you stay on until the end, I want you to know there's ethical bribes coming your way. I'll give you an Amazon gift card for staying on all the way. And then if you end up doing a pre-qualification, I'll get you a gift card to Cafe Rio for dinner because, hey, everyone wants to go have dinner. So that's what we're going to do. So let me take just a second and talk about the power of investment and leverage. And let's just say that someone bought a home for simple math, $200,000. And we're going to use the increase in the market to generate a big return on your money. And let's just say you used a standard 3% down program. This is pretty easy. You can get this done with a 620 score, 3% down on a conventional loan. And let's say that we were living in a traditional 6% market climate. Doug, is that a fair return for the long haul in real estate?
That's a fair return, and 200,000 is a pretty good price for a new, starter home, condo, townhome.
Okay.
So
I'm trying to be as honest and just kind of showing reality. So you sell it for 3 years later, as 6% a year. Your sales price is $238. So we're going to have some fees and some costs. But the profit you made is $17,000. And can you tell me where you can go and invest $6,000 in a safe place that will turn into $17,000 3 years later?
I don't know of any.
I don't know of any either. So I love real estate. I love that this is an investment as well as a place for you to live. So that 3 times your money. If you sell it every 3 years, as long as you've lived in your primary residence 3 out of the last 5 years, there's no capital gains on that, as long as the increase is not more than $500,000. So, man, you don't even get taxed on it. It's awesome. Of course, as you're living in it, you get yearly tax deductions for mortgage interest, which if you're renting right now, man, you'll end up putting way more money in your pocket at tax time, or you can adjust your withholdings and increase the cash that's coming in monthly. So there is so many great things about owning a home. So the real estate people tell us that location is all that matters. And I don't really, know how to put a definition on that other than some areas just hold their value better. And
I'll give you a great example. I had a client that bought a home in Eagle Mountain and bought it, closed it, and 2 days later they announced Facebook was coming in.
Oh,
and
wow.
the value of his home jumped $30,000, and he'd been in it 2 days.
Oh my.
So location is important.
It is so important. And a lot of times those areas that hold value are also going to appreciate more often. They're going to be up a little higher in an up market. They're going to dip down lower and lesser in a down market. So some of these areas are easier to sell in. And so take this into consideration as you're meeting with Doug. He'd love to help you understand because he's a market expert. Another thing that's important is what's access to transportation? How close are you to freeway exits? What's the time to get to town or wherever you're going to go? And then what's the traffic like on the surface roads? If you're buying in a brand new area where there's lots of open ground and lots that are being sold, realize that the traffic is just going to get heavier and heavier on the surface roads. And that's why some people like the more established areas, because they're not going to be in heavy traffic. Another thing that's important is the quality of schools. Some people move simply to be in a different school boundary. And then we want to look at the income tax or the property taxes in the area, and Doug can help you understand that. Another thing you want to consider is what's your property type and how does it suit your lifestyle right now? The standard that we think of is a single family home. Now, as what I've seen in 25 years in the industry, these things appreciate faster. They also sell faster, but it costs more to get into them. They're higher priced. Now, another option is a condo. And for first timers, for young couples, a lot of times this makes sense. For people who are downshifting out of a bigger home, a condo makes sense because often it's a lifestyle. Now, we'll talk about that, but know that a condo has a lower price. But the hard thing about it is sometimes it takes a little bit longer to get out of a condo. And the appreciation in value will be more slow in this kind of a place. But the nice thing about it, go ahead.
With your condos too, a lot of times you get a lot of amenities with it. You get a swimming pool, you get a gym.
Yeah.
So you may not have to pay for a gym membership because you have one built in already.
Yeah.
So there's advantages there too.
Plus a lifestyle thing. You don't have to mow the lawn. You don't have to rake leaves.
Shovel the snow.
Your time is your time. So there is some huge benefits to that. And if that's where you are in your life, man, that's an awesome thing to consider. And a lot of times there's some social stuff that's revolving around the workout facility and the pool. So good stuff. Another thing is a manufactured home. These, again, are a little bit less expensive, and these are a little bit harder to finance. We want to make sure that they are on a fixed foundation. But the downside with it is sometimes these will tend to lose value just a little bit. They definitely don't appreciate as much as a normal single family home, and they're a little harder to sell. Now, one of the great home runs that I see a lot of people is they buy a duplex and they'll move into one side and then they'll rent out the other side and use that money from the other side to help pay the rent or pay the mortgage. And man, it is awesome. Of course, it's easier to afford because you can use the rent from the other side to help you pay for the home. Sometimes you can buy a more expensive property because you have the rent on the other side. Again, it's a little slower to sell because it's not just, every single person who's looking for a single family home will take a duplex.
And they're a little harder to find.
They are, because there's a lot of value because you're competing with investors that know where they want to put their money in a safe place that's going to give them a cash flow that shows up in their mailbox every single month. It's awesome. And there'll come a time when you're in, it's time for you to go buy rental properties for your retirement, but this might not be that. Well, let's talk a little bit about tax advantage because there is some great tax advantages, and I am not qualified to give you specific tax advice this year. I have some ideas, but don't rely on me. Go check with your CPA, but these are questions you need to ask. Now, right now, if you're renting, you probably are not picking up, well, you're obviously not picking up mortgage interest. You might not be itemizing. You might be taking the standard deduction. So the question becomes, how does adding the interest that you will pay into this equation change things? And chances are it's going to allow you to itemize and probably pay less in tax or be able to get more back if you're a W-2 kind of an employee. For instance, it might reduce your tax burden if you're in a 22% tax bracket. Trump just made a big tax program overhaul. I love it. And you're probably in a 22% tax bracket. And if you're paying $18,000 in mortgage interest, which based on payments, that's probably what you're going to see, your tax burden could hypothetically reduce $3,600, which means you could put $3,600 in your pocket on a refund, $4,000. Or again, if you reduce your withholdings at work, if you're currently having 1 or 2 withholdings, go adjust it to 4 or 5. They will withhold less in tax, which means your paycheck will go up and you'll have more money to afford the home. And that way you don't have to wait for a year to get this $4,000 back from the government.
That's awesome.
Good stuff. Good stuff there. Rent currently has no tax advantages. So know that, and you probably feel it. So the standard stuff, again, for a lot of first timers or people who maybe even don't have kids, and so they don't get that tax deduction. So there's great stuff there. Well, let's talk about what makes up your payment because there are big parts. And in our industry, we have a lot of acronyms, which are things that make tons of sense to us, but doesn't make sense to the real normal world. So PITI is something that you'll hear. And the P&I is principal and interest. This is the repayment to the lender. A little bit of principal, a lot of interest up front, but it's repaying the loan. That's what they call the P&I. Now, there are property taxes. And again, depending on your location, your taxes will be higher or lower. But this is the annual property taxes. And the lenders usually like to break that up into 1/12 of the annual and take it out and hold it for you. So you pay 1/12 every month. And at the end of the year, they have the money to make that payment for you. I is insurance, and there's a couple of factors for insurance. One is homeowner's insurance. The lender will demand that you keep your home insured. Don't worry, I'm going to get you 4 or 5 quotes. I'm going to find you the lowest one, and you can pick, and they almost always pick this certain one, but I'm going to get you some great homeowner's insurance coverage. Now, there's another thing involved called mortgage insurance, and mortgage insurance is an awesome thing. It gets a bad rap in the world, but man, if we didn't have mortgage insurance, Doug, would not have anybody to sell houses to because everyone would have to come in with 20% to buy a home. And mortgage insurance is what the lenders demand we pay because it's paying for someone else to step in if something happens to you and there's a default. The lender will pay the mortgage insurance company will pay the lender for whatever they don't get out of the house if it's sold on a fire sale. So mortgage insurance is awesome. It lets us buy homes with 3% down or even no money down, and it's just part of your payment. And if there's an A, PITA plus A, is if you pick something that has a homeowners association. And that's usually paying for the amenities that Doug was talking about in the condo complex. Sometimes it's taking care of the snow removal or the lawn mowing or the pool. So a condo or a planned unit development will have that. And this is usually comes up in a place where there's a lot of homes squoze it into a small part of the ground. It's called density. When the density is high, you usually have a homeowners association. So enough about that. Excuse me, sorry about that. Let's talk a little bit about qualifying, because one of the things we're going to talk about is your income and how much home you can buy based on the income that we can prove. Now, qualifying ratios are what I'm going to look at. And what they want to look at is your monthly payments that you pay every single month, not including utilities. It's, your car, your credit cards, your student loans, and your mortgage. And they divide that by your annual income. And this is the gross income, the amount they're paying you before the taxes. And back in the day, we wanted to have 29% of your income going towards the housing and a total of 41% all in. So we could add 12% of car payment and all the other kinds of debt. Now, we have since added automated underwriting that Fannie Mae believes that they're smarter than people. And so we can go as high as 58, almost 58% on an FHA loan. So you probably won't be comfortable with that kind of a payment on your income, but we can do it. And sometimes it makes sense because we can't prove all the income that you have. And so maybe there's income we can't prove, and so you can afford it. So we can make that happen. But really, the first question I'm going to ask you is, what are you comfortable paying? And then we'll go and we'll find you that kind of a home.
Now, in the real estate world, what we do is we have you go through this ahead of time, so that way we're not running around looking at houses that you can't afford, and that when you do find one, that when we make an offer for you, the sellers know that you are qualified, and it makes it that much easier of a transaction. It takes out a lot of pain for us. So this is a great thing to do ahead of time.
Yep. I think we've taught the society to do it backwards. We should first go get pre-qualified for a loan so we know what our payments will be based on what we can buy, and then we know what to tell the realtors when we go to work. But here we are making it work. So we want to consider also near-term changes in your life. Maybe when you get the loan, the two spouses are working and they're planning on having a baby, and so it's only going to be one. So let's make sure that we're planning on what's happening coming up soon. Are you going to have kids? Are you planning on a job change or sending someone back to school? So let's make sure we get you in the right kind of loan. And fixed rate loans are awesome, especially in an interest rate market where things are going up. We want to secure them now. But for certain periods of time, an adjustable rate mortgage, an ARM, makes sense. And that is, hey, I'm going to law school in 5 years. I know I'm selling this in this house, or I'm going in 3 years. It might make sense to take a 5-year adjustable rate mortgage. And an ARM is something that stays fixed for 5 years, and then it will adjust once a year after that. And that might make some sense for you, especially if you're moving. Or we can do something called a buy down, where it helps ease you into being a homeowner, where we pay some money up front to the lender. It's kind of like prepaying a discount on your payment. So say we locked you ongoing at 6.5, maybe the going rate would be 5.75 in this case. We lock you at 6.5. They let you start at 4.5. You stay at 4.5 for 1 year, and then you go to 5.5 for the next year, and then for the rest of the term, you're back to 6.5. So that helps as you move into it. But we can look at that, and again, we'll find what makes sense for you. Now, here's what to expect to get the loan. We're going to have 2 of everything. We got to have 2 years worth of your tax returns if you're a self-employed or maybe an independent contractor. If you're an employee person, you get a W-2, I need 2 years of W-2s. They want to see your 2 most recent pay stubs. They want to look at your 2 most recent bank statements, and is if you're doing a down payment program and you've got you're going to put money down, we want to see where that money's been for 2 months. And then we're going to want to see 2 years of where you've worked. And we want to see 2 years of where you've lived. And fewer changes makes the underwriters happier. They're looking for stability, and it's our job to paint a beautiful picture of someone really stable that's going to repay this loan. And so the fewer job changes we have in the last 2 years, the better. The fewer moves we have, the better. Now, if you're moving up and if you've got some different jobs, we just need to prove that you're trying to improve yourself. The next job was better than the last one. So we'll make that happen. And then we need to see a copy of your driver's license because there's some things with the Patriot Act that we've got to prove who you are. So there's that. Let's talk just a minute about credit scores because, man, everything is driven by credit scoring. And there's so many things that come into play.
Are these like golf scores? The lower ones win?
No.
Oh, okay.
It's like my golf score. I wish the high score would have golf because that's where I am. So just, you probably hear a lot of talk, freecreditreport.com, and that doesn't always correlate to what a mortgage credit number looks like, but it's pretty close. But just know that we're looking for a 7. If you're a 740, you're going to qualify for the best rates. If you're 620, it lets us do a conventional loan, which is kind of like the industry standard. If you have a 580, I can still get you 3.5% down on an FHA loan. Now, there's ways that we can increase credit. And so it makes sense to come in and talk. Let's look at where you are. And then I've got plans and programs to up this. Sometimes it's paying down balances on revolving accounts. Sometimes it's opening credits at different places. It's really unfair credit scoring because if Doug has credit at, say, Nordstrom and American Express, and he has the exact same balances as me, and I have a credit card, say, at Kmart and at maybe a jewelry store, his score will be higher than mine because he uses a higher, he shops at higher end stores.
I use Nordstrom's instead of Kmart.
And for whatever reason, that scores better. Again, wow. It's unfair, but it is what it is. So let's talk. First things first, let's look at your credit and let's talk about what we can do to get it up there because there's some really great things we can do quickly. And then if we need to work on a long-term, I've got some great programs.
And as far as this goes, on the real estate side, the realtor that you're working with, hopefully that's me, but we don't see any of this stuff. This is why we've got the team with Gary and I here is you work with the financials with Gary. I don't see any of that. Once you guys have worked that through, then we bring that final number to me and say, okay, this is what we can afford, and then that's what we go find you. Yeah. So it's held very confident in a lot of confidence with Gary, and it's not shared. So yeah. You and he are the only ones that would know.
Yep, and I forget later on, so it's all good. So we'll take great care of you, and it's definitely kept all very confidential, and there's very, very secure in the way we move documents around. So be confident in that. Let's talk a little bit about down payment because this matters a lot. Now, a lot of reasons people don't buy homes, and one of them is they feel like they don't have money down. And there are still today some awesome no money down programs. Now, if you live in a little bit of outskirts of the community, you can get 100% on a USDA rural housing loan, and those loans are awesome.
So to give you a quick example, if you lived down in Saratoga Springs in the Lehigh area, and you lived west of the Jordan River, then that would qualify for that USDA no money down.
Yep, and take advantage of while it is because I think the next time they look around, they're going to move that out a little further. But yeah, for sure. And then if you happen to have served in the military, the VA loan is the best loan of all. That thing is awesome. I wish I could do everyone on a VA loan. It's a great benefit for the military. And then anywhere you want to live, we can do Utah housing. There are some loan limits, but if you have a 620 credit score, we can get you no money down with Utah housing. So there's good stuff. In fact, you can do USDA down to 581, believe it or not. So if again, we're in one of those areas that was rural development, we can do it down to 581. Utah housing, we can go with the 620. So VA, we could probably go 582. So there's lenders that will do that. Now, kind of the standard for home buying is a 3% down or a 3.5% down. And I will say this, if we can find 3%, it'll probably save you $100 a month on your payment. And the other thing about that is if we can find 3% down, you'll probably be able to buy about $20,000 to $30,000 more home just because our interest rates are lower, and that lets our max qualifying payment buy more home. And so if we can find money, I'm going to try and get you to do that just because your payment's going to be a lot easier and you're going to be able to buy more home. But we can go do that with less, we can do that. So we can do 3% conventional with a 620. We can do, again, down to 580, 3.5% down FHA. So great stuff there. Another loan that we've got is a 5% down. The interest rate is almost the same as the 3%. The mortgage insurance is just a little bit less. So a lot of what we see is 3%. That kind of feels like the standard right now. So a lot of people are going to say, yeah, but on a no money down, do I still need money to buy the house? And we wanted to find something called cash to close. And this is what money has to come into the title company when you close to get your keys. And there's three parts that make up the cash to close. Now, the first one is the down payment amount, the 3% down or the 3.5% down. And this is for the lender's benefit. And the idea is if you've got some skin in the game, they feel like you're not going to walk away from the house. If you've got a gift from your grandma, you're not going to walk away from the house because you have to look her in the face. And so they feel like if things get tough, you're going to stay and dig and work hard to keep the house. So the down payment is really for the lender's benefit, and it goes to them. It's a percentage of the purchase price.
So, but on a $100,000 home, a 3%, you're $3,000. So it's pretty easy to calculate.
Yeah, to the down payment. Yep.
Sure.
Now, there is something on every single loan called prepaids. And this is something that we don't seem to calculate until we sit down and write numbers and I put it on paper for you. But prepaids are for your benefit in the early part of the loan. So they make us buy 1 year of your homeowner's insurance right up front. So it's paid in advance. And then again, they're going to collect 1/12 of that for the next year. So they have the money to pay for it again in a year. So they make you pay for that up front. Then they make you pay daily interest until the end of the month that you close in. So mortgage interest is paid in arrears, which means that if I close today, which is October the 25th, I'm going to have to give them 6 days of interest when I close. And then I skip the month of November and that interest accrues. And then my December 1 payment, I'm paying interest for the use of November. So we pay odd days interest till the end of the month. So we're square with the lender moving forward when you get your first payment. So bear in mind, you're going to skip a payment. So that makes it nice. And then we've got closing costs. Now, these are the things that are paying people to work on our loan. We've got an appraiser that goes out and makes an estimate of your home. We've got title company that's doing research to make sure that you're going to be the owner of the home and no one else has a claim on that. We've got people at the lender that are underwriting you, that are making sure everything goes, that are drawing your documents. There's probably 14 people that work on your loan all told. And so these closing costs go to pay them. And so generally speaking, you're probably going to need about $4,000 to cover prepaids and closing costs on a smaller home loan like this. And so quite often it makes good sense to go get seller paid closing costs if we can.
In addition to that, when you buy the home from the real estate side, when you buy it, you make an offer and you have money that goes into escrow. And typically that's, I would tell you, you'd want to be about $1,000 earnest money, so that way, they know that the offer, again, your offer is serious and they know you're ready to close.
So even on a no money down loan, even on a Utah Housing or USDA, you're going to have earnest money. And
Correct.
So we're probably going to need about $1,000. And
Right.
The idea is that tells the seller we're serious. We're putting this up front. If we fall out at a certain point in time, that money becomes available to the seller, and that allows them to take us seriously. So realize you're going to have to come up with that, and that could be a loan. That could be, a gift from your parents or from your grandma. But just know that we're going to have some earnest money. And Doug already alluded to this, but don't skip steps. There is a natural order of things. And the question is, how do you know how much house to look for?
I'm going to look on Zillow. No, don't do that.
But you got to know what your payment is. And so you got to start with me. You got to start with the lender. Let's get your numbers. And we'll find out what you can afford, what the lenders think you can afford, and then you'll find what you want. You'll probably push the envelope of that. You'll say, oh, Gary, I can afford $1,400. And then you're going to find this house with Doug that maybe gets you in at $1,500, and we're going to have a conversation. And I'm going to say, this is the hardest it's ever going to be on you. You're going to get raises from now for the rest of your life, and your fixed interest rate is going to stay the same. So it gets easier every year, and we'll talk about where you want to be. So just know that. But you got to start with the lender and then go look for the properties because it makes sense for you and it makes sense for Doug. And he already talked about this, and I call it the law of pre-approval. Don't even think about going through a house until you know you can qualify. It messes with you emotionally, and it's wasting your time. Now, Doug also mentioned that it strengthens your offer if you send over a pre-approval. And so that way the seller looks at you and goes, yeah, I'll accept their offer. The money's already handled. I'm happy with that. So then I'm looking at how fast I can close. I'm looking at what the earnest money is, and I'm looking at the strength of this pre-approval. And that lets you compete against cash offers. And Doug, you've done some cash offers in your life. I think a lot of times they come in a little lower because they can say it's a done deal, and that's one of their strategies. So sometimes someone who has a solid pre-approval can actually get a home offering higher than a cash buyer.
And that's true. And even in our market, especially in this new home buyers market, there's a lot of competition from investors as well as the millennial group and stuff that want to own these homes. And so the better and more solid you can make your offer, the better advantage you have going forward.
Yep, for sure. So we want this. We want to present you in the strongest light we can, and you got to have one of these, or the seller's not even going to consider it. So spend a few minutes. We can do it on the phone. Give me 7 or 8 minutes. We can make this happen. If we want to take longer, we sure can, but I can do it that fast. So I'll go ahead.
I was just going to say, one of the things that we want to talk, I would recommend talking to Gary, is there's a difference between your banks and your mortgage people. Typically your banks they want to keep you in-house. They have a specific program that they try to funnel everybody into, which can or can't be a good thing. But with Gary and the mortgage industry, they have more options that they can play with.
Sure do.
It's not just one, funnel. It's a whole lot of different options. So it really is an advantage to come talk to Gary and the mortgage.
Yeah, and I'm a mortgage broker, which basically means that I can get you more home at the same payment than you can get from the bank or the credit union. And everyone thinks, I'll go to the credit union. They have the best rates and the lowest closing costs. And it's not true. They're going to charge you an origination fee, which is 1% of the loan amount or 0.5% of the loan amount. I competed against an America First Credit Union one the other day. And if we were doing the same interest rate, $6,000 difference in closing costs. They charge $6,000 more. Or I can just give you a lower rate and come in with the same closing costs. But I'm telling you, I can.
That's your down payment.
It's a lot of money. It's a lot of money. So I can do a lot of things that the banks can't. And so, hey, let's talk. So let's talk about you. What can you qualify for? Because that's all that matters. And let's plan your strategy. Let's figure out if your credit score needs to bump up to get you the payment that you need. Let's get going on that. Let's figure out what that happens. And so I had a $10 Amazon gift card for everyone who showed up and stayed through the webinar. So send me an email, Gary@thesimplechoice.com, and I'll send you a $10 Amazon gift card for listening to us for 30 minutes. We thought we were only going to be 20, but here we are at 30, Doug.
Wow.
Time flies when we're having fun, right?
Yep.
And then if you do get on the phone with me and we spend 7 or 8 minutes and I get you that pre-approval, we can do it over the phone. We can do it in person at our office here in Draper or wherever you want to meet. I will give you a $25 gift card to Cafe Rio because you deserve to eat. So it's an ethical bribe that I talked about at the beginning. But
it's a great way to sit down and you get pre-approved, go to dinner, then you and your wife or your significant other or mom, dad, whatever, can talk about where you want to live.
That's right. And then we'll get a hold of Doug. Yep. We'll definitely, when we have you pre-approved and ready, we'll hand you over to Doug and you can go grab that. So my number, 801-560-2999. Let's talk anytime. My office is open almost all the time. And then, like he mentioned, if you have property type questions, or where you want to live, or all things market driven and property. I'm the money guy. Doug is the property and the house guy. And so you can get to him at
Doug T at utahproperties.com, 385-224-1994.
So this is your home buying team. We would love to need to show you what you can qualify for. You will get the expertise from Doug and the area. And I've never seen a more fastidious broker that takes care of the people and is on top of it like I've seen with Doug. He's awesome. So guys, get with us. Let's get you your gift cards. Let's get you your pre-approval letters. Let's get you out into your first home. It is within your reach.